Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now think of any situation when you require funds to clear your financial debts or responsibilities. One product that may come to your immediate rescue is a personal loan. Now a personal loan can be a quick way to pay off your existing financial expenses, be it your education loan, credit card bill, house renovation, or even a wedding. Now in today's episode, we are going to take you through this product in detail and try and analyze why it is one of the most promising options worth considering, but at the same time it's important for you to do your due diligence as they do have a higher interest rate. Now let's welcome our guest Naveen Kukreja, Managing Director PaisaBazaar.com. Welcome to the show. Naveen, now it's an important topic, personal loans. A lot of people are going in for it. We are seeing this trend increase. Why is that so, and why does personal loan look to be such a convenient option?
Thanks, Arjun. So if you look at it from a consumer perspective, call it consumerism or better financial awareness, people are now getting more comfortable with the concept of debt. Think of our parents' generation where debt was almost a taboo. Anything other than home loan was not considered good from a debt perspective. But today's generation is not that kind of hesitant to take debt when they need to clear off either a financial obligation, like you said, or they need funds for a specific situations, because it's also probably because they're more confident about themselves. They are earning, they're usually both earning if it's a family, and they are in more control of their financials. That's from the consumer side. From the bank side, what's happened is in the last 7 to 8 years, credit bureaus have come in and have become more and more stronger. So we have, or the banks have a lot more data about the consumers in terms of the credit history. That gives them a lot more confidence before lending to the consumer, because they have a far better understanding of what are the chances of repayment, which is a key criteria.
Right, and what about the charges, both from the interest perspective? I mean, how much do you end up paying? What's the broadband? And also, what are the other charges associated with the personal loans?
That's a very good question, Arjun. While interest rate is the primary charge, most consumers end up looking at only that component, which is not the right thing. When you're taking or going for a personal loans, of course, look at the interest rate and the EMI, but also be careful and look at the processing fee. Mostly banks would charge a processing fee along with when you're applying for a loan, which is primarily to cover their operation cost. That typically ranges between 0.5 to 1%. There will be a standard rate, but you can have a discussion with the bank and try and negotiate a little bit to bring it down a little. The other charge one must be very careful of is the prepayment charges, especially if you are salaried or if you're looking at prepaying the loan in the near future, or if you expect things like bonuses where you plan to prepay. Most of the banks typically now have prepayment charges which are reasonably high, ranging from 3 to 5% of the outstanding loan amount. There are a couple of institutions who do not have prepayment charges, so do compare before kind of taking the personal loan.
Right, so what are the considerations for a bank or financial institutions to give you a personal loan? I mean, you'd mentioned credit history and you'd talked about the salary, but go into the kind of paperwork that is needed, and how long does it usually take to disburse a loan like this? Because we talked about emergency funds needed, so you might go in for a personal loan for that.
Yeah, talking about the criteria, banks typically look at 2 or 3 large criteria. The first and most important is the credit history that we talked about. There are 3 or 4 bureaus which are existing, and they have now data on most of the consumers. So bank look at that as a very, very strong indicator of what the consumer's credit history is. That defines on the eligibility, on whether the consumer will get the loan or not, and also at what pricing does the consumer get the loan. The better your credit score, the lower your interest rate is likely to be. The other things that they look at is, of course, the income, because that defines your ability to pay, and that also defines the quantum of loan that the bank is ready to give you. One of the other things that banks look at is whether what's your profession. So if you're salaried with a good organization, that gives a lot of confidence to the banks. It's easier for you to get the loan. If you are a professional like a doctor or a chartered accountant, it's again relatively easier, because the banks have a large amount of history and are more comfortable. Typically in self-employed non-professional segments, fewer banks lend to this segment, and it becomes slightly cumbersome. From a process and the timing perspective, for if you're salaried again and have good credit history, the process is becoming more and more faster. It used to take more than a week till about a year back. Now banks, there are institutions who are doing the loans in 48 to 72 hours if you are in the best category of consumer. And I know that there are a couple of institutions who are working to bring it down to within the day and some hours, which is a good progress from a process perspective. If you are self-employed, the documentation is slightly cumbersome in terms of your ITRs, your profit and loss statements, etc., and it typically takes slightly longer.
Right now, whenever we take a loan, one of the criteria has to be the regularity and the timeliness of making those payments. We need to do that whether we take a home loan or a credit card. Is it more so as far as personal loans are concerned, and what are some of the charges that you might face if you do not pay in time?
Yeah, it's a very good question. Credit score is becoming a lot more important in all lending. Specifically, like you said, in unsecured lending, because personal loans per se is unsecured. There is no collateral that you're giving against that. So you have to ensure that your credit score is good. You have been making payments timely on your existing loan products. If you look at CIBIL score, typically CIBIL provides a particular score basis your credit history. So if your score is above 750, you are likely to get loan very, very easily at better prices from almost all the institutions that you want to apply with. If you are in the score range of 700 to 750, which means you've had some issue with some loan product, so some banks will consider you for loan, some banks would not. If your score is below 700, it becomes very difficult for you to get unsecured loan for sure. Even secured loans, you may have some issues and you may need to clarify. If you're new to credit, the bureaus or credit bureaus typically assign a score of 0, which means they don't have enough history about you, which is interesting because you haven't taken any loan in the past. But banks then tread a little more cautiously. Not all banks would give you loan, and the banks that would give you loan, they will take slightly longer and probably at a slightly higher interest rate. So it's very important that you maintain a good credit history, or if you do not have credit history, start building one by opting for simpler products like credit cards.
Right, Naveen, and what about personal loans to pay off credit card bills, which might have spiraled for whatever reason? Does it make sense?
It absolutely makes sense. We see a lot of consumers doing that. We advise consumers to do that. If you have credit card outstandings across multiple cards which you're not able to handle or pay off immediately, taking a personal loans and clearing off that debt is a very good idea, because typically credit card interest rates are in the range of 36% per annum, which is pretty high. Personal loans, if you get one, you will get it in the range of between 13 and 18%, depending on your credit profile and where you're employed and your salary. So in either of those scenarios, it just makes sense to kind of take a personal loans, clear off your card outstanding, and then have different equated monthly installments to pay off the personal loan.
All right, what about the different kinds of personal loans or different collaterals that maybe that you might want to secure your personal loan with? Are there any advantages like whether gold or property? Does that fall under the ambit of personal loans?
Rightly said, Arjun, that all of these loans that you talked about, whether it's personal loans, unsecured loan, or gold loan or loan against property, are for personal usage. So banks, what that means is that you can take it for any particular use that you have for personal usage, whether it's to pay off card debt or whether it's for a particular need related to your business or family, or it's a wedding or a vacation that you want to take and you take a loan for that. If you're taking it against any collateral, then it's called an unsecured or a personal loan in common parlance. If you have gold against which you take the loan, your gold or asset works as a collateral. And if you kind of take it against your property, you have an existing property, you want to take it, that's called a loan against property. But all of that is for personal loans. There are different reasons and different pros and cons for taking this all three kinds of loans.
Right, now, is it better to avail of a personal loan than mortgaging one's property? Is that the right way to put it?
Yeah. So it depends on what quantum of loan you're looking at. It depends on how long are you looking to avail that loan for, and it also depends on that you're comfortable with mortgaging your property. The mortgaging property loan against property interest rates are slightly lower because your property is kept as a collateral. So the interest rates typically would be between starting from 11.5% going up to 13-14%. Whereas a personal loan typically starts from 13% and goes up to 18-19%. So you'll get a benefit of lower interest rate. You also get a higher quantum. So depending on the value of the property, you can get loans up to 70% of the value of the property. So if you're looking for higher quantum, loan against property is a good option. If you're also looking for loan for a longer tenor for whatever reason, a loan against property gives you loans up to 15 years, whereas personal loans, unsecured loans work for a lower tenor, which is ranging from 1 year to 5.5 years. However, because loan against property does require some processing and valuing of property, it takes typically slightly longer. So if you're not in need of funds immediately, you could look at loan against property as an option, lower interest rate. It takes about 15-20 days to process the loan.
Now, is there a differential between, there are two kinds of personal loans, interest as far as interest rates are. One is the flat interest rate, one is the reducing interest rate. Now, what are the pros and cons for both of them?
So reducing...
And does it really make a difference at the end of the day?
It does. It's important for consumers to know. Most of the banks would offer loans at reducing interest rates, which essentially means that if you took a loan of 6 lakhs to start with, let's say, your interest is calculated on the 6 lakhs, but 2 years later, let's say your principal outstanding has gone down to 3.5 lakhs, the interest after 2 years is calculated on the outstanding amount, which is 3.5 lakhs, which is why it's called reducing interest rate, because it is calculated on the outstanding amount. Flat interest rate is calculated on the total amount at all points in time. Even 2 years after you take the loan of 6 lakhs, the interest rate would be calculated at the total amount, which is 6 lakhs. Ask very specifically the question from the bank that you are taking the loan from. Go for the reducing interest rate, because that's simpler to understand. It's easier to understand the exact interest rate. Flat interest rates actually are much higher. Most of the banks actually give a reducing interest rate, but just do make sure to ask that question anyways.
And Naveen, it's an important subject, personal loans. A lot of people are going in for them, but they're not really comparing, they're not looking at the pros and cons. That's what we are trying to do, deconstruct that for them. Now, what about gold loans? We're hearing a lot about gold loans, a lot of advertisements, a lot of companies coming in there. Gold loans versus personal loans. Go into the pros and cons of that.
Yeah, you're right that gold loans as a concept has become popular in the last few years. Initially started by a couple of NBFCs, and now banks have got excited about that. It's a good way to unlock the value of gold lying in your lockers. In scenarios where it makes sense is that if you need a small amount of loans for smaller tenor, gold loan is a good way to unlock the value of the gold. You typically have loan tenors ranging starting from 15 as low as 15 days, going up to 15 to 18 months. So if you're looking for a loan for shorter tenor to kind of finish or pay off something specific, and then you will get funds in near future, gold loans is a good tool. It typically does not have prepayment charges, but do ask and look for that information if you are going for that loan. Basically how it works is that the NBFC or the bank will take your gold, have a valuer who's sitting right in the branch, value your gold and give you a loan against that. The loan value is typically about 70% of the gold value of the gold, 65 to 70% of the value of the gold. Because they are able to value it immediately, the disbursal is pretty fast. You can expect to get the money within an hour or a couple of hours, the time it takes for them to value the gold. So it's faster, it's for lower tenor. It typically has lower or no prepayment charges, but it does require you to put gold as a collateral.
So what would your top tips be for someone who's looking for a personal loan?
So if you're looking for a loan, first of all, you have to be very clear on the reason you're taking the loan for and the time horizon that you're taking the loan for. And also from your financial position, understand that whether you have a good chance of repaying that loan earlier, or you will pay that late at the due intervals. So that becomes an important factor when you look for prepayment charges, etc. Also look at whether you need the funds immediately or you can wait a little bit. So if you need it really urgently, gold loan can be a good option, and if you need it for a shorter tenor. If you are comfortable to wait for 3 to 5 days and have good credit history, then personal loan, unsecured loan works the best, because there is no collateral that you're giving, and you will get the loan for a longer tenor and longer amounts depending on your income and credit score. However, if you're looking for a larger sum for a longer period or have some issues with your credit history, then you may consider putting your property as a collateral and take a loan against property. But my suggestion would be that be clear on the reason, be clear on the time horizon. Do compare your options by visiting sites like ours, Bazaar.com, and look at all the options in terms of interest rate and the other charges before deciding on taking the loan.
Right, Naveen, it's time to take our viewers' questions. We've got Shubham, who's 40 years old, and he started taking loans quite early in life for a vehicle, wedding, house and education. Soon after, he was not able to make the timely payments that are required owing to certain circumstances, thereby affecting his credit history. Now, he wants to know what he can do to improve his credit score.
Shubham, it does happen sometimes if you're not very disciplined with your finances, that you kind of end up in this situation. But it's good that you are conscious of that fact and you want to improve your credit score. My suggestion would be that since you know what products you had and the banks that provided those products, reach out to the banks that you had loans or credit cards from. Ask them for a total outstanding statement. Do have a discussion with them on how much can they bring it down. Banks typically have flexibility to reduce the interest component of the loan, but you will have to pay at least the principal plus some interest. So do negotiate with the banks and slowly and steadily try and clear off the debts. Banks do also can convert your total outstanding into equated monthly installments to make it easier for you to pay off. But do kind of do those discussions and then pay off your loan slowly and steadily.
Right, we've got Gaurav Sharma, who's about 3 to 5 years away from his retirement, and he would like to know if he can apply for home loan, a home loan after retirement.
It does become difficult to get a home loan after retirement because you do not have any source of income. My suggestion would be that if you need a home loan and if you can take it now, then you take it now because you're still earning. The other way to do that would be that if you can have somebody as a joint applicant, like your son or somebody in your family who is an earning member, then it becomes slightly easier for you to get the home loan.
Right, Naveen, that's all the time that we have on this episode of Policy Bazaar. But last week we asked you a question, what does EMI stand for? And the correct answer is equal monthly installment. Yes, it's equal monthly installment. And the winner is Gaurav. And this week's question is, what does CIBIL, C-I-B-I-L, stand for? You can send in your entries to queries@policybazaar.com. And thanks a lot once again, Naveen. Very important subject of personal loans. But that's all the time that we have. But you can also tweet us at Twitter @PolicyBazaar_in. And we'll see you next time with another episode of Policy Bazaar. Goodbye.